Hi, this is Bruce Weinstein with Weinstein Wealth Insurance Solutions. Today, I wanted to talk to you about how to be defensive with your investment portfolio. Right now, we've got historic high levels on stocks, mutual funds, S&P index, whatever your measurement is. And we've got historically low interest rates. And as the commentary goes, bonds are defensive, but they're not safe. People think they're safe, but when we have rising interest rates, bond prices collapse just as fast as any bad stock might collapse. And so the challenge as a financial professional might face with their clients or the clients in general is, how do I protect my portfolio? How do I lock in profits? What do I put my money in if I decide to make a shift in my risk, my portfolio exposure? When the markets crash, everybody wants to get out. Wall Street has an inherent conflict of interest of actually telling you to get out before the collapse has already occurred, right? It's yelling fire in a movie theater. There's nobody going to buy if everybody's selling. So you have to make your own determination, with or without a financial professional, on how to manage your money and what to do with your decisions, locking in profits, taking a piece off the top, as they say, sell high, right? Buy low, reallocate. The challenge right now is if you go to cash, there's really no return on cash. You can buy real estate. That's, again, probably pretty frothy. I'm not even going to get into Bitcoin and all that conversation. But your conventional stocks and bond portfolio, question is, what do you do? I don't want to be in the market. What do I do? I don't want to be in bonds. What do I do? And so maybe it's popular, maybe it's not, maybe it's controversial, obviously, when there are people out there telling you don't buy annuities. But there's annuity programs out there called an indexed annuity that actually preserves capital. You have guarantees and floors to protect never getting downside risk. So if the market were to crash, your mutual funds are going to drop 30, 40%. You're going to wait quite a while for that money to potentially come back. If you're buying a bond fund and rates go from 2% to 4%, the value of those bonds, if you needed to raise money or liquidate, are getting destroyed. And with a bond fund, you don't know when that value is going to come back. You have an individual bond, you wait till maturity. But a lot of people bought 30-year bonds, and they're probably not going to want to wait 30 years to get their money back if there's other opportunities. So it presents that challenge. So the conversation I've had with clients over the years is simply to take a piece of that money, their bond exposure money, especially in today's environment, and put it in something like an indexed annuity that will give them some modest upside. And again, the conversation is modest, 2, 3, 4, 5%, maybe a little bit more. But you have to temper expectations. This is not where you're making money. This is not where you're going to double and triple your money in a week. Go play Bitcoin, right? Go buy that Dogecoin, whatever. Okay. This is to protect money till better opportunities come about, or depending on how old you are, is just to make sure you don't lose it, that you have that money available to you. And so as the conversation goes, if your money lost 50%, you have 50 cents on a dollar. Well, what's the rate of return you need to get your dollar back? It's 100%, right? 50 cents to go back to a dollar needs 100% rate of return. So if we encounter a 50% correction in the stock market at some point, I don't know when, and I'm not telling you it's now, not professing, stock market highs and lows, but if you watch Game of Thrones, winter's coming. Okay. So the piper's going to get paid at some point. We've got 10 years of a pretty much straight upward market, COVID aside, when we had that painful month or so pullback. So think about that without the fast, swift V-shaped recovery, right? So you're going to move to bonds thinking I'm going to be safe and protected. The 10-year treasury went from like 0.6 to 1.8. And those people who paid for the bond with a 0.6 return were getting destroyed on paper. How long are you going to wait? And you got 9.5 years when your bond is now priced at 50, 60, 30 cents on the dollar suddenly. So you need to take a piece of your money. You need to use things like indexed annuities and position your fixed income alternative asset class and use something like that. Something that we offer. Happy to talk you through it, evaluate your portfolios. Not going to get into all the nuts and bolts today, but just have the conceptual conversation of how it can be applied and why. And Weinstein Wealth Insurance Solutions, you can give us a call. 732-407-8063 is my personal cell. Look at the website. I guess it's over there. Where is it? Over here. No, it's over there. There it is. Scan my V card. You can communicate with us. Okay. But again, remember, very simple message. Bonds are defensive. They're not necessarily safe. And if you're going to move your money from equities and add more bonds, you're going to walk into the next frying pan as rates continue to go up. Look at gas prices and oil and inflation and gold, and there's Bitcoin, and these alternative asset classes are moving. Stocks are starting to crack a little bit. Bonds and interest rates are going up. People are clamoring to get real estate with historically low interest rates. I've been saying that for 20 years. We've gone from 8% rates to 5% rates to 3% rates. Okay. So act wisely, seek advice. There's plenty of advisors out there. I've been doing this for almost 35 years. I'm happy to talk with anybody. No cost, no obligation. As I say simply, I have nothing to sell. I'm only here to solve problems. We're happy to talk about your problems. Give us a call at Weinstein Wealth. This is Bruce Weinstein. You have a good day.